Welcome to the AS Gold Weekly Outlook. Here is your midweek roadmap for gold, the XAUUSD pair, across the 11th and 12th of June 2026. We will cover the macro picture, geopolitics, inflation, and the key technical levels. First, where gold stands. Spot trades near 41.15 to 41.40 an ounce, down 11 to 12% on the month and back at 2026 lows. Price is below the 200-day average at 44.44. The daily RSI is deeply oversold, and the short-term bias is bearish. The big picture. Gold has erased its entire 2026 year-to-date gain. The decisive move was the break below the 200-day moving average, which flipped the medium-term trend bearish and triggered technical selling. Yet price still sits far below January's record high, and a deeply oversold market keeps two-way risk alive. Our base case for the two sessions is a bearish to neutral, heavy tape, with choppy trade between 40.060 and 42.55. A break of 4100 opens the door lower, but oversold momentum raises the odds of a sharp short covering bounce. Watch producer prices, consumer sentiment, and Iran headlines. Driver 1. Inflation. May CPI, released today, ran hot at plus 0.5% on the month and plus 4.2% on the year. That is the fastest annual inflation in over 3 years, and it hardens the case for a higher-for-longer federal producer prices land Thursday. A cooler print is the most likely bullish trigger for gold. Driver 2. Jobs. May payrolls smashed expectations at 172,000. Unemployment held at 4.3%, and prior months were revised higher. A resilient labor market removes any urgency for Fed cuts and underpins the dollar. That has been a key catalyst behind gold's slide. Driver 3. The Federal Reserve. Rates are on hold at 3.5% to 3.75%, but markets now price around a 70% chance of a hike this year, and Goldman has removed all 2026 cuts. The June meeting, the first under hawkish chair Kevin Warsh, brings a fresh dot plot. Drivers 4 and 5, growth and geopolitics. First quarter GDP grew about 1.6%, keeping stagflation worries alive. On geopolitics, U.S. and Iran diplomacy over the Strait of Hormuz remains unresolved. A firm dollar is weighing on gold for now, but any escalation could spike prices instantly. Driver 6, structural demand. Record central bank buying and ongoing de-dollarization continue to put a firm floor under the market. This persistent official sector and physical demand is the main reason analysts still flag sharp bounce potential, even while the short-term tape stays heavy. Now the technicals. Gold is below every key moving average, the 20, 50, and 200-day, with a clear sequence of lower highs and lower lows. The break of 44.44 exposes the 4100 region. This is a deep correction, but not yet a confirmed reversal. Momentum is stretched. The daily RSI sits around 25 to 28, deeply oversold. MACD is firmly negative, confirming selling pressure. But the money flow index is ticking up, a possible bear trap warning. Bearish, but ripe for a relief bounce. On the upside, the levels to reclaim. 41.57 is the first hurdle, then 42.02 to 42.55, and 43.14 above that. The big one is 44.44, the 200-day average, and the line that flips the bias back to bullish. On the downside, the line in the sand is 4100, the March low. Below it, 40.060 and 40.006 come into play, then 39.52, 38.94, and 38.20 as the deeper measured move target. Putting it together, we expect Thursday and Friday to trade roughly between 40.060 and 42.55. The wider week is volatile into the Fed, and the broader June range runs from 41.86 up toward 49.33. Scenario A, the highest probability path, is bearish continuation. A hot producer price print, or a firmer dollar, drives a sustained break of 4100, opening 40,006, then the 3800s. This view is wrong only if price reclaims and holds above 4157. Scenario B, rising in probability, is an oversold bounce. Deeply stretched momentum, a cooler producer price print, or short covering into the Fed lets gold defend 4100 and rally toward 4255 with a stretch target near 4314. Scenario C, lower probability but high impact, is a bullish reversal. An Iran or Hormuz escalation, or a dovish shock, could drive a run back to 4444. A close above that level would neutralize the entire breakdown. A word on risk. Event risk this week is elevated and two-sided, so keep size modest and stops defined. Remember, oversold is not the same as reversed. Wait for a reclaim of 4157 to confirm, and watch the dollar index, treasury yields, and crude oil in real time. Your catalyst calendar. Thursday brings May producer prices and jobless claims. Friday, the University of Michigan sentiment and inflation survey. Then the FOMC decision and dot plot on the 16th and 17th. And throughout, keep one eye on Iran and the Strait of Hormuz. The bottom line. The path of least resistance is lower to sideways while gold trades below 4444 and beneath 4157. Treat 4100 as the line in the sand. The macro backdrop favors selling rallies, but oversold momentum and Hormuz risk makes snapback spikes likely. Trade the levels, not your conviction. That is your midweek gold outlook. If this helped, please like, subscribe, and turn on alerts so you never miss an update. Remember, this is for educational purposes only and not investment advice. Trade safe, and we will see you next time.